everyone, good evening. You're watching The Money Show on ET Now's Rise with India Primetime segment. As always, I'm Mubina Kapasi, and the show is dedicated to making you smarter with your money, whether it's investing it, growing it, or spending it in the right manner. Here's what we have lined up on the show. Today, we're going to be talking about investing in the fixed deposits that small finance banks offer. If you don't know what small finance banks are, we'll get to that. But just to sort of introduce you to it, they're basically banks that offer a way higher, let's not say way higher, but at least a 2 to 3 percentage point higher interest rate than fixed deposits. The question is, should you switch your fixed deposit from a regular bank to a small finance bank? Also, after the finance minister has essentially tweaked the laws with respect to deductions and deposits, still are PPFs and ELSs a lucrative investment for investors? Later on the show, we'll be talking about the PM Vaya Vandana Yojana. It's going to be actually invalid from the 31st of March. So you have till the 31st of March to opt for this scheme. Who is it for? What are the benefits? What are the risks involved? We'll be talking about that. And in our Spend with TMS segment, we'll be talking about the glittery asset, looks-wise as well as return-wise, and that's gold. A lot of you guys have gold in your lockers. The question is, with this rally that we've been seeing in prices, what should you do with gold? How can you essentially take advantage of this massive price surge? But back with the Money Show to talk about the topics with respect to, firstly, fixed deposits with small finance banks, and secondly, the lucrativity, if that's a word, of essentially PPFs as well as ELSs, especially since now FM Sitharaman has basically taken away the tax advantage that these two products offered by giving investors another option. That just pay me a lower interest rate, pardon me, a tax rate, and you can simply just not invest in the PPF and ELSs. So we'll be talking about both of these topics with Kalpesh Ashar. He's right here with us in the studios. Kalpesh, always a pleasure having you with us. Now, the reason we thought of talking about this entire small finance bank bit is because they simply offer a way better interest return, right? I mean, 2% more, at least 2% more than your regular banks. Just again, for the benefit of our viewers, your small finance banks are essentially the Ujjivan Small Finance Bank, AU Small Finance. Basically, any bank name that ends with the nomenclature of small finance bank, just to put it simply, is your small finance bank. And they do offer a higher interest rate. So like I said, the reason why we would like to talk about is not just because of the higher returns, but also because in the budget, what essentially FM Sitharaman has done is she's increased the insurance cover. So where the government steps in and says that, look, if the bank fails, we'll step in and we will assure a certain amount. So it was 1 lakh rupees. It's increased 5x to 5 lakh rupees. Kalpesh, would that tempt you to invest in small finance banks?
See, first let's understand from where we come from and where this question arises.
Yeah.
So the core of this is that we've had the drastic effect of I think it's still ongoing of the PMC case right in front of us, where there has been a major disaster and all the investors of that PMC bank are still, I think, not finding any solution to it, and they're left in the lurch. So it stems from that, and the bank itself has been in a total, I think, shutdown mode, and due to all its fraudulent activities which were going on in that. Now, the deposit insurance and credit guarantee which is offered, we all know for ages it's been 1 lakh of rupees, and there was always, I would say, a hue and cry that it should be increased, and the government kept it at a standstill till this event occurred. And in the recent budget, that limit has now been hiked to 5 lakh. Now, let's understand that when is this 5 lakh paid? So on paper, it looks very good that the government is covering you for a guarantee of 5 lakh rupees. But it is not going to be paid to the depositors or the people who are left in the distress till actually the bank is a closure. The bank attains closure. And I think that's at the fag end of the whole process. In between all the litigations and all the protests and all the hue and cry which goes about is where actually even PMC Bank is, and none of them have got anything from that 1 lakh also, because the bank has not actually been declared as a closed bank. And those cases are very rare. Now, we have to understand in between what happens. Now, the 1 lakh or the increased 5 lakh, although it's 5 times more, and if some people say inflation adjusted, I still doubt it. The problem is that people either have money to the tune of 1 lakh or 5 lakh rupees, but what happens is people have got larger sums in that. And that is a major problem. that the lure of the higher interest, like what you said, it's obvious, it's there, that the normal small finance bank or these cooperative banks, the rate of interest is anywhere between 8 and 9%, whereas a normal SBI bank rate is today 6%. So there's a glaring 2 to 3% interest rate difference there, which is the biggest attraction. That is what is pushing all these people to go to those small banks. Apart from that, what do these small banks do? Offer, convenient banking hours and lots of other perks to the people, which makes it convenient for the retail investor to go and bank with them. But all said and done, it is the lure of the higher interest rates which is pulling people there. And more importantly, what needs to be understood here is that this deposits which are there includes everything. It's just not your fixed deposits. It also includes your savings and all those things there. And the people who are left in that lurch have made that cardinal mistake of putting everything what they have into that one particular thing and not diversified enough. So there are 2-3 crucial points to be understood, that this money won't be paid to the, I think the bereaved people who have been losing their money till the bank has been closed. And second, the lure of high interest rate is what is pulling the people to get into these small finance banks and all the other cooperative banks, which have one of them which has headed towards a problem.
Like you mentioned, we have seen that insurance guarantee amount at 1 lakh rupees for the longest time. And it's only now when PMC happened that they increased it 5x. But I think there's one thing that you should give credit to Indian banking, and that is that no bank has actually reached that juncture.
Absolutely. And that is precisely the reason why I'm saying is that they've given the end result. That if it happens, we'll come and stand for you. But in between, there's a lot of water flowing in between. So there could be a merger of the bank which is suffering a problem, or there could be a delayed type of a payment. But what happens during that time is that poor investor loses a lot of money. His whole life has depended on it. And although the government takes control, but what goes between that in an individual's life, I think is a complete distress type of a situation. So the government has not let any bank fail thus far.
Exactly. So you know what? I mean, I'm just going to tease your brains a little over here. The market's obviously not doing well. I mean, I'm seeing on my screens over the Sensex below 40,000. There are very few avenues today that offer me good interest rates. Compared to an NCD, I would still say maybe an SFB would comparatively be a little less risky. And it's giving me 8, 9, 9.5% interest rate. And if you're a senior citizen, probably more. With the probability of, the bank failing being so little, do you think it's still a risk worth taking?
So let's play it in another way, because you're telling me you're going to tease my brains. I'm going to expand it a bit more. Okay. So let's look at the options available with people. Okay. So for the normal person who does not want to get into complications or still be, attached or attracted to the word bank. Once the word bank comes, a lot of people think that everything is secure. A piece of advice for them is a normal common sense approach is that even the SFB, and let's understand that, like what you're rightly saying, even the SFB is not a loose entity. So it is regulated by RBI. It has got its own nomenclatures and it has got its own regulations. The only issue with the small finance banks is the lending which happens through those banks is through a segment which is very sector oriented, or it's a very, I would say, a very low ticket type of loans are given. Recovery might be difficult. The ticket size is not large, but it is regulated by RBI, and RBI will not let it fail. So what is a common sense approach? What I'm talking about is that even in that, so if ideally if you have now the limit of 5 lakh, do not invest more than 5 lakh rupees in an SFB.
Okay.
Secondly, do not invest only in one SFB. And if you have an FD basket, now if you're only attached to the word FD and you can't think beyond that, okay, we are financial planners, we give a lot of options which are logical, but let's stick to a very basic and a very orthodox type of investment mode, which is FD.
I think it's a favorite among
Indians. It's a favorite and it's a no-brainer.
Right.
So in that also, so if you have that, don't invest more than 5 lakh rupee with an SFB. Again, don't invest only with one SFB. Diversify into 2 SFBs. And in that, also keep a huge chunk of it, if your FD portfolio is there, with the recognized private sector and the public sector banks. So your ICICI banks of the world, SBI, or the HDFC bank in the private sector, Kotak, or the SBI. And then say if you have 100 rupees to be put in FDs, you could put say 20 rupees in a small finance bank just to please your senses that you're getting something more than the normal accomplished safe banks.
Okay,
so
all right.
you can play the diversification thing in the FD also.
Okay, so diversification is not just for stocks and mutual funds, it's also for SFBs. And you're tempted, go ahead, but invest under 5 lakh rupees in totality in all your small finance banks. Very quickly, Kalpesh, I want to talk about the other topic, and that's PPF and ELSS. Now, of course, the government has said that, you know what, you just pay me a lower tax rate, but then all the tax benefits of these two options are gone. So let's say even if I do want to opt for that lower tax rate, do you think it's still worthy for me to put my money in an ELSS and PPF?
So I'll add one more to the couple which you have said. That's a senior citizen savings scheme.
Right. Yeah.
Yeah. So that's these three options have been fantastic standalone products. Also, apart from the tax incentive attached to them.
Okay.
So people were putting in money in PPF and also availing of the tax benefit. But let's look at PPF in its entirety. It's still a 7.9% tax-free product. Okay.
Exempt. Tax interest is also exempt.
Exempt. So it was a triple E product. And today, if you're not availing of the new tax regime and still sticking on to that, that remains. And if you still were to see that if you are a family of 4 and people were putting in 1.5 in each family head's name, you were still effectively putting in 6 lakh rupees at 7.9% for a long-term debt allocation. And if you were to put your normal tax slab onto it, add your 20-30%, it's effectively a 9.5-10% product. So a 7.9% tax-free product, PPF, and more importantly, Mubina, let's not forget, it's a sovereign guaranteed product. It's Government of India. Okay. So although the tax benefit, if you take it away, you could still look at it as a part in the earlier segment which I mentioned of your fixed income allocation. If you are, have been in it for a long time, there's no need to look at it now because just the tax intensive has been withdrawn from that. Secondly, you come to the senior citizen savings scheme. I think it's one of the most lucrative regular income sovereign guaranteed investment product for senior citizens we have. And look at the rate of interest on that right now. It's almost, if I'm not mistaken, it's 8.6 or something, which the senior citizens are getting. Regular quarterly payout, although taxable. This is a taxable product. And only the benefit of tax for the people who put in the senior citizen was in the first year when they put in that money on a staggered basis or lump sum. So senior citizen also is a brilliant regular income generating product for the senior citizen fraternity, and they should look at it in isolation. This is not again a tax oriented product which you should look at now that the tax is not there, I'm not going to invest in it. And the third one you asked was ELSS. Now, again, if you're not going to be a part of the new tax structure and compulsorily you want to have your money locked in, you understand what is the feature of equity, that you don't want to look at it on a short-term basis. You want your investments to be locked in. The only lock-in product which I recommend in the equity universe is the ELSS. It comes with a 3-year lock-in and equity-oriented scheme. So you get the best of equity through this investment. You have this little bit of mental solace that your money is locked in and you're disciplined in your investment approach.
Okay, all right. So lots essentially over here in terms of investing lessons, great products, standalone as well. You don't necessarily have to look at it only from that tax saving point of view. PPF, ELSS, even a senior citizen saving scheme like Kalpesh said, apart from of course SFBs, who would give you 8.5% and that too exempt. Similarly, PPF, it's exempt when you're earning the interest, which is every year, and even after 15 years when you want to withdraw the money, it's completely exempt. So again, a great standalone product. Well, let's take forward our discussion on financial planning, on fixed deposits and more by answering your viewer queries. So our Ask the Money Show segment will now kickstart. Our phone lines are open. You can call in, and any questions or queries you may be having on fixed deposits, on small finance banks, on ELSS, on PPF, you can get those answered right now. We have Babani Charan Das, who's written into us saying, I am a senior citizen and only earn via bank deposits. Nationalized banks do not offer high interests like the small finance banks. That's exactly the topic that we've been discussing. But his question is it safe to have fixed deposits in small finance banks? Now, Mr. Das is actually relying on the income that he earns from these fixed deposits. So in such a situation, would you even recommend him putting that 5 lakh rupees or just absolutely stay away?
So this question is in fact a blessing for our program show today.
Yeah.
It expands the horizon.
Yes.
And when it expands the horizon, what I mean is that we've already spoken about the perils or the advantages of the SFB. And I've said that it comes with its amount of risk in it. I would surely suggest the senior citizen fraternity to genuinely stay away from the SFB fixed deposits. And come what may, I think at this age, you can't risk your capital. Your income levels, could be up and down, but you cannot afford losing your capital on any product. You can have a product which will give you a regular flow of income if it is planned well. And the answer to that is by putting your money into debt funds and starting a systematic withdrawal plan. Now, you could take the advice of a good, financial planner or a good financial advisor and plan this complete process out. Because what it offers is that it will give you a very lucrative option beyond 3 years when you're ready to put in your money for fixed deposits over the conventional, bank FDs or something. And you will get a fixed amount which you desire, which is your requirement as a regular flow at a particular date. So look at the debt fund options. It is coming with an element of risk. Today, no investment product comes with complete risk-free type of a thing. You have to understand the risk, what it takes. You need to allocate in different baskets. And one more option I would like to give here is that, instead of an SFB, the middle path here is you could even look at a AAA rated corporate FD.
Okay.
So that is still an option which I would suggest that you could still divide your money, like I said, creating a basket. That if you still want to put your money in your conventional FDs, do that. Corporate FDs could offer you again a little regular payout, but not the complete allocation to one particular asset class. So neither to your fixed deposits, to the conventional ones, which would not let you earn a very decent rate of interest, nor the corporate FDs, there could be a small portion. And thirdly, to the debt funds. I think this will ensure, and obviously if you're a senior citizen, we just covered the last segment, senior citizen savings scheme. That will open up, which will open up the complete, I think, regular flow, and it will at least ensure you some stability of your capital.
And the rate's also a bit higher than your
Obviously,
banks,
senior citizen is giving you a very good rate.
Yeah. Okay. All right. Well, I think we have time for one more query. So let's get to that. We have Siddhartha writing into us saying that my wife is 37 years old. I am 41 years old and have been investing in mutual funds via SIP and lump sum for the last 6 years. He's an IT professional. Current holdings in mutual funds is 1.5 crore rupees. Now, he wants us to review his investments. He wants to accumulate 10 crores for his retirement in 15 years, and for child's education I will need 1.5 crores after 10 years. Okay, so I think his total amount is basically 3 crore rupees currently. 3 crore rupees roughly is what his 11.5 crore rupees is what his total requirement will be in the long term. That's at least after 10 years. Up until now he's accumulated only 1.5 crore. Okay, now I think his mutual fund list is, I think, the longest we've seen in the history of the Money Show, to be honest. I think it'll take me the whole show literally to read out the entire list. But, you can see some of the holdings in his portfolio at this point of time. There's a mix of equity mutual funds and debt mutual funds. And, in fact, in the email, he's acknowledged that, according to me, our mutual fund list is too long. Kalpesh, without, I don't want to waste time sort of going through the entire list. It's already there for you to see. What's your view of this extremely long portfolio? So
fortunately, I've taken a cognizance of the enormous number of schemes he has, and at least he's aware of the fact that he's got too many schemes. And Siddharth, believe me, you have too many schemes. You have, in fact, I made a count of it while the thing was on. You have 22 equity funds and 15 debt funds. That's way too many.
Yeah.
I think it just doesn't serve the purpose. You're complicating your portfolio, you're complicating your returns, you are doubling your paperwork, and it's adding up to nothing. And one more, I think, candid confession which you've made is that you've invested as per themes and flavor of the season. As advisors, that's the last thing we advise people to do. I think investments should be made according to your goals, and your portfolio needs a major reshuffle. And a little bit of appreciation for what you've done is you've taken account of your future goals. So you are aware of where you want to head, in what time period, and what sort of approximate amount you require. Although this requires a more meticulous planning through an advisor to how much amount would you require when these goals would come up. So that is as far as your portfolio goes. Now, all the schemes which you've chosen, I think, are absolutely like what you said, have been flavor of the season or captains in their own year or performance at some point of time. And believe me, we've been tracking mutual funds for the last 15, 20 years. Every 1 year or 2 years, the captains change. So it's never that the ones which are the forerunners right now would be the forerunners in time to come. There's a lot of study which we need to do, how to select funds and what you need. So recommending what you need for your portfolio, Siddharth, is first of all, you need good potential, proper financial planning advice. You don't need more than 6 equity funds and 3 debt funds in your portfolio. I think that would suffice. And you've also, a good thing is you mentioned you don't have any short-term goals. So if you don't have short-term goals, you don't need 15 debt funds. I think 3 debt funds just to keep a little bit of balance in your allocation is good enough. And on that count, I would just like to suggest out of your portfolio what you've done and a couple of other ones is that you can go in for 2 large cap funds. You can continue with the ICICI Pru Nifty Index Fund. That's the cheapest way to have your exposure to the index and the blue chip space. You can go in for the Mire Large Cap Fund, which you already have. You can go in for the Kotak Standard Multi-Cap and the SBI Focused Equity Fund in the multi-cap space. And in the Kotak Emerging Equity Fund, which you have, that will suffice for your mid-cap allocation. I would just like to add the ICICI Prudential Balanced Advantage Fund just to give the equity portfolio a little bit of sanity, considering the markets go up and down. And on the debt funds, always be at the shorter end of the curve, come what may. So in that case, the IDFC Bond Fund, which you have, IDFC Bond Fund short-term plan is the one I recommend. The second one is Aditya Birla Sun Life Corporate Bond Fund and the ICICI Prudential Savings Fund. Now, these 3 funds are at the shorter end of the curve, and always it's better to remain a bit conservative in the debt fund category. So get professional advice and stay disciplined.
Okay, so cut the clutter firstly. There are too many funds you're owning, and Kalpesh has basically shortened the list down significantly. It's a lesson for all our other viewers as well. You do not need to be practically holding the entire market because that's just simply a logistical nightmare as well for you to keep track of all your funds. Okay, well, on that note, we'll wrap it up on this edition of Ask the Money Show. Thank you, Kalpesh, for joining us, and of course sharing with us some very interesting insights into small finance banks and his tips as well. And of course, folks, just because FM Sitaraman has said that you don't need to invest in ELSS and PPF, that does not mean you stop doing that. That's of course Kalpesh's view. We'll take a very short break, but when we return, there's more in store for all our retirees watching. Stay tuned to ET Now.